Hi there, Jason Moser, analyst with Motley Fool One. Thanks again for joining us for another edition of Ask a Fool. Today we're taking a question from Sid, and Sid asks, what's your foolish take on Starbucks? What about their breathtaking PE? How about Realty Income? It's a great company, but even their PE seems high to me. And so Sid, I'll tackle the Starbucks part of this question first. The beauty of Starbucks really is that it has so many ways to succeed now as it continues to strengthen its execution. CFO Troy Alstead and even CEO Howard Schultz continue to believe that La Boulange, the food acquisition from a little while back, will have a profound impact on Starbucks' business there. So there's a lot of upside. If we think about food is really only included in just about 1/3 of the transactions that occur in Starbucks stores today. So that's a lot of opportunity there for them to really get that food part right and boost those sales numbers. But a second area of excellent growth here is when they start expanding with more drive-thrus into roughly 60% of the new stores. This will generate more sales, it'll boost profit margins, and open up a flood of new real estate opportunities as well. But then also consider things like China, India, Teavana, Evolution Fresh. These are all examples of great growth opportunities that Starbucks is incorporating into its business model. Now, in regard to the PE, I suspect that you're referring to the inflated 7,786 number that's on most finance sites today. But remember, the settlement with Kraft just happened, and that was recorded as an operating expense on Starbucks' income statement, which virtually wiped out their earnings. So if we take their normalized earnings, the real earnings from the year of $1.7 billion, and we apply that to their $58 billion market cap, we get a PE of around 34, which is about right. That's much more a realistic picture of what the company's worth today. And I think it's a decent valuation, actually, for a stable, reliable business that is still growing. Now, in regard to Realty Income, it's not a company that I cover, but it is a real estate investment trust, which means that it should normally pay a higher dividend. But it's also going to be a riskier proposition as it's very dependent on, number one, competent management, but also number two, the real estate market. And that's something that's not necessarily under their control. And if we look at past performance, that doesn't necessarily tell us what the future holds, but it's worth knowing that Realty Income has underperformed the market over the last 5 years, 2 years, 1 year, and year to date. So, just consider that when looking at it. But I hope I was able to clear things up for you. Thanks for the question. And for more information, make sure to check out Fool.com.